later. All right. Okay. So, like I said, I mean, you need the knowledge. A lot of people, they tend to, want to fast track. They tend to want to walk without crawling as a child, right? After one's birth, there's a stage where you crawl, and then there's a stage where you stand, and then there's a stage where you start taking one step at a time, and you start walking, and your futures are all developing. Okay, so that's the way it is with forex market. So the most important thing in forex market or in forex trading is the knowledge. And like I said, once you get the knowledge, there's no limit to what you can do. Okay, so that's why so much emphasis in being placed on the knowledge. But today there are a lot of materials online that you can actually use to learn forex, as I mean, on a self-paced basis, and you can actually understand it to some extent. But then it's better when you have a guide or you have a mentor. A mentor will probably probably help you to change the game and cut that learning curve for you and make that learning curve faster for you. Okay, unlike if you are just doing it yourself. Okay, then so let me just open the second slide. This one and then this one. Okay, so just before I continue, is anyone having any question from our previous classes? Just any question. Let's do like 10 minutes. Any question? Okay, so in the absence of any question, let's dive into business for the day. So we've done this before, okay, and like I said, I'll just do a quick recap. We've talked about trend line. Trend line is one of the most popular concepts in trading, okay? But a lot of people misconstrue the idea. Some probably have a way of drawing it, by by practice, after extended use of trend line, they've drawn it, and they got it to that point where whatever they draw work for them. But that in itself is not a principle. So there's actually a principle of drawing trend line. And we need to look at this principle critically when we are drawing trend lines. Okay. So for the purpose of this class, we did the one of uptrend the last time and we didn't touch downtrend. So I'll just run through it, go to downtrend and see I will draw trend lines on downtrend. It's basically the same thing like you do for uptrend. But one thing I want you to understand is whenever you see that the trend line is facing up, if the trend line is sloping up, it means that the market is going up. And if the trend line is sloping down, it means that the market is going down. Now, what trend line does for us is it helps us to determine the market speed, how fast the market will get to where it's going. Okay, so let me bring it to the layman term. If you want to go to the market, there are several routes that lead to the market. Some are faster than some, right? So that's what trend line does for you. So when you look at the trend line, let me show you. I'll just quickly jump to, okay, so all right, so I want to just explain here. Okay. So this is the long-term trend line, right? This what we have here is a long-term trend line. So now I'm not if I follow the long-term trend line, if you are looking at the long-term trend line, this slope, you see this slope, it started from here, and at some point it continues from here, at some point it continues from here. Now, if the overall plan of the market is to get to this point here, this D, right? What the trend line does for you is it helps the market gets to D faster. Faster in the sense that if the market stays on the long-term trend line like this, even though the market will get here, it will take a very long time because this, you see this slope is an upward slope. It continues to slope up, but it's gentle, it's slowly. This one also will continue to go until it gets there. But this one will take you there really, really fast. Okay. So that's one of the things that the trend line does for us. It helps us to determine the market speed, how fast the market will get to its destination. And you know that destination from our last class, because from our last class we said if you know where the market is pulling back to in terms of the Fibonacci level, then you know where the market will extend to. So if the market if the market pulls back to 61.8 level, the market will extend to 161.8 level. If the market pulls back to 78.6 level, the market will expand to 1.27 level. If the market pulls back to 86% level, the market will extend to 1.18 level. So these are fixed, fixed levels that the market will actually get to by virtue of what the Fibonacci is telling you by the time you place it on your chart. So with the trend line, you'll be able to determine more accurately how the market is going to navigate and get to that extension level. Okay, so like I said, we dealt with uptrend in our last class, so we'll just quickly move to downtrend. Okay, so everything that happens in the up direction is the same thing that happens, okay, in the down direction. So the downtrend, this is where the market starts from. The market attempt to create a price swing. And for the market to create that price swing, what the market does is that the market will create an A that is a high, a B that is a low, and a C that is a high, and then the market will drop, will extend down. Okay. When the market is extending down, the market will break this B level. Okay. The movement from point A to point B is full 100% movement. That is entire ability of the market movement from point A to point B. Then point B to point C, some people call it rest. Some people call it retracement. That is, the market is resting. Remember, those that drive the market from point A to point B, they are the bearish guys. These are the bears. Okay. But those that drive the market from point B to point C, they are the bulls. And now there's a phenomenon in the market that says that, okay, when the market is moving, there's a kind of a game, okay, a kind of a game. Just you can view it from the aspect of tug of war. Now, if you remember tug of war very well, you will see that the two sides want to win, right? Side A, side B want to win, but we all know that only one will win at a time. One person will always lead that game at a time. So you will notice that even though there's a side that is pulling the other side, after a while you see the guys that are leading tends to be losing ground, and the guys that were losing will now start gaining ground. So those periods that it takes for the side that was losing to start gaining ground they were actually undergoing some form of rest. You can also look at it for the point of a wrestling game. You see somebody that has been beating, all of a sudden gains so much strength and is not beating the person that was beating him. The whole process of that beating that he was receiving, it was actually undergoing rest. So that's what the market does. So when the market is moving from point A to point B, in the case of coming down, the bears are in full control of the market. That is, we have more sellers in the market than buyers. That is, we have people with a sell sentiment than those with buy sentiment. So because we have more sell people in the market will go down. Okay. But then it goes down to a point and it looks like it has exhausted its ability to continue to go down. And that is where you hear the word oversold and overbought. When you hear the word oversold and hear the word overbought, this is where it came from. Okay. And when you hear the word supply and demand, that in economics, this is where you activate their role in the forex market. Okay. So when the price is low, Anywhere you have low price in the market, we call that area demand zone, demand area, right? But anywhere you have high price, we call it a supply area. Okay. So when the market moves, down from point A to point B, it's actually coming from a supply zone to a demand zone. Now, when it hits that demand zone, what will happen? You will notice that the market will create a combination of 5 candles with 2 candles to the left and 2 candles to the right that are higher than the center week low. That is your support. From that, your support, the market will move again. It's not going to see another support or resistance until it gets to the point where it sees the resistance. Where the market sees that resistance, that is your high. Okay, that's your resistance. And that your high is a supply zone. So the market will change direction from there. Okay, so when the market moves to point C, it's going to change direction to start selling. Okay, when the market change direction to start selling, the bears are now in control. But the period where the market was moving from B to C, the bulls are in control because the market is actually going down. And there's also a concept, we explained it in our first class, in our in our second model, the game of support and resistance, that says that when the market is going up, the market form what we call higher highs and higher lows. But when the market is going down, the market will form what we call lower highs and lower low. So why do we say it's a lower high? This C is a high, this A is a high, but the high C is lower than the high A. So this high C is called a lower high. And this low B is higher than this low. Okay, so this low, where the market is extending to, is called a lower low. Now, take it from me. If the market continues to make lower low, no magic, there's no magic in this world that will make that market to go up. And if the market continues to make higher high, there's no magic that will make the market to come down. Okay, so when you see that the market is making lower low, your work is to determine if the market is making lower low. If the market is making lower low, congratulations. Then you are looking for an opportunity to sell the market. That's where you now invoke your strategy. That's where you bring your strategy to play. That strategy that you have learned, that thing that you have tried over time and is working. That's when you now bring it to play. When you put it in the market at that point, you will see that you will take the trade and the trade will go in your favor. So now, because we are talking about trend lines, what we want to achieve here is when the market is going down, the market is going to respect the trend line to the downside. So if this is the first, A, and this is the first B, and this is the first C, and the market is changing direction, when the market change that direction, the connection between the A and the C is your trend line. That is where the trend line starts from. Okay. When I join A to C, when I join this A to this C, that gives me my trend line. Now, if this trend line says the market is in a downtrend, what you will notice is that every point in time you see the market attempting to come back to the trend line. And whenever it comes back to the trend line and gives you a candlestick formation around the trend line, the market will go down back. Okay, because now, remember, this is a lower low. This is a lower low. This is a lower low. And I said that there's no magic that will bring this market up if this market is making lower lows. Even though, for the fact that this is a low, this is a lower low, and the market is now coming back like this, the market will not come back like this and just go and break the trend line. The market must create a higher low. And if the market cannot create a higher low, then the market will continue to do lower low downs to the downside. Okay? And that's why you say the market is worth selling. All right? So the market is selling. This is our A, this is our B, this is our C, and this is our D. Where's our C? Our C is coming from the red level. Okay, the market pulls back to the red. So there are 3 levels on the red area. 1, 2, 3. Okay, we have 38.2 level, we have a 50% level, and the 61.8% level. These 3 levels, anytime the market comes from B and gets a C in this level, when the market continues to move, it will extend to the 161.8 level. Okay, so that is the rule of thumb. So when the market does that, what you want to do, once the market has done this, when the market has done A, B, C, D, your condition for drawing your trend line is you want to see that the market has made A, the market has made B, the market has made C, and the market has gone to D. Once the market has gone to D, let me go back to the previous slide. When this is what I'm saying. The market must create this, the market must create this, the market must create this, and then the market must create this. Once the market has created this 1, 2, 3, 4 points, this 4 point is what we refer to as a price swing. Once the market has done that, you will come here and draw a line between this high and this lower high. Remember, as at that time, the market is here. When the market now moves back close to this line that you have drawn, you are now looking for a candlestick formation in that area. Anytime the markets come back to this area, you start looking for a candlestick formation. When you get a candlestick formation here, which we have talked about, and I've also shared on the WhatsApp group this morning, I shared the 5 most occurring candlestick pattern, the bullish ones and the bearish ones. Okay, when you see any of those 5 candlestick pattern, yeah, that is when you will take your trade, sell. When you sell, you put your stop loss above this lower high, you put your take profit depending on the Fibonacci level that is coming from, and you put your take profit in the corresponding extension level. Okay, that's how you trade this market. When you do that, you notice. So this is what I'm trying to explain. So this is your A, this is your B, this is your C, and then the market gives you D. I say join A to C. There are primarily 3 downtrend lines that are formed in a downtrend. One is the inner trend line, the outer trend line, and the long-term trend line. The first A, the first B, and the first C, we give you the long-term trend line. If at any time the market breaks the long-term trend line, the market has changed direction. If the market breaks the long-term trend line, it's going to do something. It's going to attempt to retest. When the market does that, trust me, the market has changed direction. So most time, it rarely comes to the long-term trend line. So in order for the market to go to its destination, it will stay below the long-term trend line. Okay? It will stay below the long-term trend line. Then, when you see, watch this, when you see that the market, let's say you drew this A to C. Watch my mouse, A to C, long-term. And the market came back to this long-term trend line, and the market drops. Now, this time the market drops, the market came back again and dropped, but it didn't touch the long-term trend line. You will now connect where the market touches, the last time the market touches the candlestick, you will now connect that place to the next high where the market created before it drops without touching the trend line. So that is your outer trend line. Okay, that's your outer trend line. The market stays on the outer trend line, for a while, stays like this up to this point, and then it comes again and did a rundown without hitting this guy. It has created another opportunity to draw a fresh trend line. So when the market comes back, you draw your inner trend line. So you keep drawing. I mean, the market keeps going like that, you keep drawing. But then when the market wants to change direction, what the market will normally do, the market will break the trend line. So the market, this is the trend line for instance now. The market will break this trend line. When the market breaks the inner trend line, it is normal that the market will gravitate to the outer trend line. And when the market breaks the outer trend line, it is normal that the market will gravitate to the long-term trend line. And when the market breaks the long-term trend line, that is a full confirmation that the market has changed direction. Okay, that tells you the market has changed direction. All right, so this is just the theory behind the trend line. So the next thing is, how do we draw them? How do we draw them in reality on our chart? So on our chart, a lot of people are in the habit of opening that chart like this. So let me take daily, for instance. This is your chart, right? So some people will say 1, 2. Okay, so this is your normal zoom. This is your chart level. Now, some people will draw the trend line on the body. Okay, some will draw the trend line on the wick. Yes, Emmanuel, you're raising your hand. I have a question.
Yes, sir. Does it then mean if I want to backtrack to the trend line that you drew, Does it
Yeah.
then mean if the price breaks the inner trend line and the outer trend line, we cannot assume that the direction of the market has changed until it breaks the outer, until it breaks the long-term outer trend line?
Okay, so yes, very
I
good
don't know if
question.
my question is clear.
Yes, very clear. Your question is, if the market breaks this inner trend line, can we consider it that the market has changed direction? That's your question, right?
Yes, yes,
You
yes,
want, or is it only when it breaks the long-term trend line that it has changed direction? Now, okay, so
yes. Yeah.
okay, uh this what you are saying is a phenomenon that occurs. It occurs. Let me bring that chart back. This is our let me move this so I can see the time frame. So, all right. Let me just take it to the all the time frames. All right, it's okay. Oh, sorry. Okay, so this is our time frames, right? This is our monthly time frame. This is our weekly time frame. This is our daily time frame. This is our 4 hour time frame, 1 hour time frame, and all. So you can go all the way to 1 minute time frame. Now, remember, all this market, they are moving together, right? If you look at this market now, if you see this value 0.60902, right? You see it's across the board. It's the same value here, the same value here, the same value here, the same value here, the same value here. That tells you the market has one sentiment, okay? So now, that trend line that you are drawing, you probably are drawing it on 1 hour, or you are drawing it on 15 minutes, or you are drawing it on daily. Now, remember that even as you are drawing on 1 hour, on 15 minutes, on lower time frame, there are also bigger trend lines, right? So when the market breaks the trend line, like I said, when the market breaks the trend line, the market will, let's use a, I'm looking for a small place to use to describe this for you. Let me see where I can use, let me zoom this one out a little bit. I want to just go back in history. Let's see where I can use to describe it for you. Okay, so let's take this one. So let's take here. We'll take this. Let's take this place. The market started from here, and then we'll say this, right? We'll say this is our uh trend line, this is our long term. Then we now come here and do this, okay, until it hits this guy. Okay, so we say this is our outer trend line. And then we can still draw the inner trend line from here up to this candle and say this is our inner trend line. So when the market, I'm assuming this part, all this has not happened, right? So the market is somewhere here. Okay. And then the market breaks this trend line, breaks this your inner trend line, and came straight all the way to the outer trend line, break the outer trend line and came to the to the long-term trend line. All right. So now maybe somebody will say, oh, the market has changed direction here, right? Say the market has changed direction because it breaks this trend line and actually attempt to go back to test it. So it actually came back to test the trend line up to this point. Okay, if you look at this movement, after breaking the trend line, the market started coming back and back and back and back and back until it hits here, right? So this is a retest for the market to now go down. Okay, so that it has broken the trend line doesn't mean that you will just take action, right? The first thing you want to do, you want to wait to see if it's going to retest the trend line, okay? And when the market was attempting to retest the trend line, once the market has formed a low, that is a support, when the market breaks the trend line and form a support, you will adjust the trend line to the new support. When it continues, you adjust it to the new support, just like that. Now remember, this your imaginary trend line is still here. This one, this first trend line is still here. Okay. So let's assume when the market breaks the line, the trend line, we came and we'll start to adjust this one. But let's leave this one there and say we're adjusting this one. Okay. So the market adjusts to this one. After the market went back and tested this one, okay, after the test, the market came back and break this one, this fresh one that we have. This is actually the new trend line now. It breaks it. As soon as it break it, the market made a rapid takeoff. Okay. So all the attempt to come and test it here did not work. It's unable to get back to this place. And then the market sold from there. Okay. So don't worry. There's a model, okay, that will explain this concept to you better after now, and that is how the larger time frame controls the smaller time frame. So you will see because now when we draw trend line, like for instance, here where the market is now, I can come here and I draw what I can see, right? I can come here and I pick this trend line and I say this is the low here, and I draw it here and I say this is long term, okay? And then the market was swinging up, it's swinging up. Now the market, the last low was here. So I'll just pick my line. And so initially it was here and then eventually it's here. Okay, so this is the last trend line that was broken. And then in this case, this is your long term. Okay, you see that the market is attempting to come down to the long term. That doesn't mean that it does not have a challenge here of a past resistance that can become future support. Okay, so we look at it holistically. You cannot just look at it that, oh, this trend line that we are drawing, they are dynamic lines. Why this horizontal one, they are fixed lines, right? So even though you are considering the trend line, you will also consider the zones, the demand zone and the supply zones, the area where the market is coming from. So there are several things that can make the market to move in a particular way, right? So the trend line is just one of the many tools that you use. So don't just jump into the market because the trend line is broken. Most time, many people that does that, they end up losing because a lot of the time, in fact, 90% of the time, the market will break the trend line and come and test the trend line. So most time we'll say, what is more important for us is what the market does at the back of the trend line. So when the market breaks the trend line, what did it do at the back? We tend to wait to see if the market is going to come back to test the trend line before we attempt to take our trade. Okay, so the change in direction, the overall market change in direction is not just the trend line alone that we use to determine it, but if you see that the market has broken a long-term trend line, then there's a high tendency that market has changed direction. Okay, it's just one consideration. But there's another better way to know that the market has changed direction. In fact, that one is crystal clear when you see it. You will see it crystal clear that the market has changed direction. And now in between, so this is a big market, right? So let me close up, take this one. This is a big market. Now inside your ABCD, you can still have smaller ABCD. So you have sub A, sub B, sub C, sub D inside your ABCD. Okay, so we are going to come to that phenomenon too, where we have to treat it that way. So in a nutshell, to answer your question, yes, if the market breaks the inner trend line, it does not necessarily mean that the market has changed direction. Okay, in some cases, it could lead to, okay, but in a lot of cases, it's not. It's just a temporary break, and sometimes after the market tests the back of the trend line, the market will continue in its original direction. Okay. All right, is it clear?
Yeah, it's clear. It's correct. Very clear.
It's clear, sir. Just some new people I know will be finding it difficult, but as time goes on.
Okay, so don't worry, we'll get there. So this is the trend line. So you see the market, as the market moves, the market continues to, to create ABCDs. That's the order in which the market moves. Continue to create ABCDs. So once you're able to determine, or you're able to identify the A, the B, the C, and the D, then your trading journey, in fact, your trading journey, I can say you have arrived, okay? Because you will know when not to enter the market, and you will know when to enter the market, okay? All right. So when the market is going up, the market stays on top of the trend line. And when the market is coming down, the market stays below the trend line. So before you attempt to drop trend line, okay, so let me just explain the principle here. When the market is going up like this is A, this is B, this is C, this is D, the market will continue to do A, B, C, D, A, B, C, D, A, B, C, D, A, B, C, D. And now these ABCDs are in the up direction. A, B, C, D in the up direction. Now the market is going to get to a point where that ABCD in the up direction will change to ABCD in the down direction. Okay, so it goes ABCD up, and then it comes back to this point. Now the market is supposed to do A, B, C, another D to the upside. But unfortunately, the market did not do it. The market did A, B. Instead of the market to do C and go to the upside, the market breaks the trend line. This is why I would say the market breaks the trend line. Now, when the market breaks the trend line, what will necessarily happen is that the market will attempt to want to test the trend line. It is the process where the market is trying to test the trend line. That's when the market will create a high that is lower, that is below the trend line. When the market, this is a low, and the market will say move between high and low. So if the market creates a low, it will go and create a high. If it creates a high, it will go and create a low, just like that. So when the market creates this low, goes create this high, came back, we expect the market to create a low somewhere here, but unfortunately, it did not create a low. Instead, what happened? It breaks the trend line, and it didn't just stop by breaking the trend line. It came and break the A. This is your A, B. When the market takes out the A, take note, something is about to happen. In fact, when the market breaks the trend line, for this case, when the market is going up like this, when the market breaks the trend line, we say at this point in time, instead of the market going up, we say now the market is no longer 100% bullish again. At this point, 30% is out of it. We can say the market is now 20% bullish and 20% bearish. That is when it breaks the trend line. Now, the market takes another step by breaking below the A. When the market breaks below the A, we say the market is now 50% bullish and 50% bearish. That is, it's now 50-50. The market may go up because the market can still come from here. Instead of coming here and creating a high, breaks above this line again and run all the way to go and create a high up here. Okay, but at this point, it's a 50-50 chance that the market will do that. Okay, and when the market does that, break the A, we say the market is 50-50. Then we'll now wait and the market comes behind the trend line and give us a high. When the market gives us a high, at this point, we will say the market is now 80% bearish, 20% bullish. Okay, no longer 50-50. The chances that the market will go down is now higher. Now, when the market now come and breaks this low here, break this low, okay, then we'll now come and draw this trend line. We'll draw this A to this C, and we'll wait for the market to come back here and give us a sell signal. Then we'll say the market is now 100% bearish. Does that make sense to anybody? The market is now 100% bearish.
Yeah, it
At
does.
at that point, you're no longer scared that the market is going to go against you. You now have confidence that the market is going to go in your direction because the market has done one, A, the market has done B, the market has done C, and the market has done the first D. Your best entry, the best entry in this forex market is continuation trade. We have continuation trade, we have reversal trade. Reversal trade are somehow dicey because just like I was explaining, 100% bullish, 80% bullish, 20% bearish, 50-50, all this whole process, they are uncertain. But when the market has done this, it has done A, B, C, D. It means that the market has successfully created a price swing in the down direction. Okay? It has successfully created a price swing in the down direction. Remember, all the price swing it was creating initially were all in the up direction. And now it has successfully created a price swing in the down direction. And for those of you that are confused, when you look at your chart, you say, oh, where is the A? I just showed you the A now. From this explanation I made, the A should be crystal clear to you right now. What is the A? The A is that high from where the market came and take out the trend line and also break the last low before the last high. So the last low is your A. Let me bring a material that explains it better to you guys. I've not gotten to that course, but let me just switch to that course. How the larger time frame control the smaller time frame. I just want to do an explanation. Maybe it will be clearer for you. Okay, so this is not the subject, but I just want to make it clear so that you can see how the market does that directional change. Okay, so this is the market. Okay, so the market, when the market is going up, is doing A, B, C, D in the up direction. When the market is going to go down, the market will do A, B, C, D in the down direction. Now, where a lot of people get it wrong is we want to take it from the very beginning, most especially amateur traders like us. We want to take it from the very beginning. We don't want to miss any of the pips, right? So most time we end up entering the market when the market has not told us that direction has changed. So somebody will just come and enter the market from here. Somebody will come and enter the market from here. Someone will come and enter the market from here. No, you have to wait for the market to do A, B, C, D. Once the market has done the first A, B, C, D, that first A, B, C, D from the lowest point is your beginning point. So when you connect your A and your C, you now have an uptrend line. From there, you can now start thinking of trading the market in the up direction. The same thing for the down. So what I'm trying to explain that made me come here is this. This is your A, B, C, D. A, B, C, D. Remember, in our last class, we talked about how the ABCDs are formed. So when the market creates A, B, C, and D, when it creates D, the last C and the last D, they become your new A and your B. And then you wait for a new C that will take you to the next D. Automatically, this D and this C become another A, B. You wait for the market to create another C that will take you to the next D. So what you are looking for in the market is C to D, C to D, C to D. Your waiting point is your B to C. So for every B to C, you are waiting. From C to D, you are buying. From C to D, you are selling. That's what you want to do. Okay. So the market creates this, and then I say, when the market is going to change direction, it's also going to start creating A, B, C, D in the down direction. But how does that happen? That's when we bring our trend line in. This is our trend line. So we draw our trend line A, B, C, D, A, B, C, D, A, B, C, D, A, B, C, D. Watch this. A, B, C, D, A, B, C, D to this point. That was the point I was trying to explain to you. And then the market comes down. Instead of the market to go to C to D, the market breaks the trend line. Step number one. Step number two, the market takes out the last A. Look at the A. If you draw a horizontal line here, you see that the market has broken this A. When the market breaks the A, trust me, this market has switched to 50% chance of going up and 50% chance of going down. Then what will now make it beautiful for you to know that the market is going to actually go down is when the market now come and create a high below this trend line that it has broken. If the market is not going to go down, the market is going to gain enough momentum to break above the trend line again. But because it couldn't, the market has created 3 points for us now. A, B, C. Your A is a high, your B is a low, your C is a high. Connect the two highs together. That will give you the down trend line. You see that? It gives you the down trend line. Now, once it gives you the down trend line, your A, B, C, D is a full price swing. I say for you to trade this market, wait for the market to come close to that trend line, this new trend line that you have drawn. From here, you can now start selling. You can sell from here while your market is still running. You wait for the market to pull back again, add another position here. The market is still running. You wait the market pull back again, add another position here. You can have 3 solid positions going down at the same time in this market. Okay, so now watch the beauty of this place. I want you to take note. Like I said, we have not gotten to this class, but I just have to bring it for clarity purpose. When the market is going to change direction, the market is going to do one thing. The market is going to create a crown formation. Crown. Look at it. This is your A, B, C, D to the upside. And this is your A, B, C, D to the downside. When you join the two, look at it here. When you join these two, when you join these two, this A, B, C, D to the upside, and then A, B, C, D to the downside. When you close these two together, join them together, if you move them to touch each other, that's where you have this, okay? This, remember, at this point, they are not touching, right? At this point, they are not touching. Now, when you join them together, it gives you the shape of a crown. This is a crown. This is the left tip of the crown. This is the right tip of the crown. And once you draw a line across this place, you will see a crown. And when you see a vertical standing crown, it means the market is changing from bullish to bearish. That is, the market is going to change direction from buy to sell. And when you see an inverted crown, it means the market is going to change direction from sell to buy. This is the best, most accurate way to determine that the market has changed direction. Is this clear to all of us?
Yeah, it's okay. It's clear, sir.
Yeah.
Okay. All right. So let's jump back to our presentation. Okay. So this one can go. All right. So back here. No, I don't think I've seen it. Let me check. I think okay, so all this things I did now is just to explain this small place. And if you look at this place that I'm talking about now, did you see the crown formation? This is the bottom of the crown. This is the left tip. This is the right tip. And then when you join these two, it gives you a crown formation. Once the market has formed a crown formation, pause. Wait for the market to pull back to the trend line. From there, you can start trading. You can start selling, you can start buying, and you can start making your pips. So this is how it is in reality on a real chart, right? So for the first step for us, what we want to do, okay, let me just go back a little bit and give you the process. So this is the procedure to draw the trend line. The first thing you want to do, you draw the trend line across the highs of resistance, connecting the A's and the C's after a new low has been made. The long-term trend line is drawn after compressing the chart and connecting the first A or highest high with the next lower high. Then the outer trend line is drawn starting from the previous point, this previous high below the long-term trend line. And an inner trend line is drawn starting with the previous high below the outer trend line. So it's crystal clear. So this is just how we do it. We compress the chart, we make the chart very small, okay, to the minimum, barest minimum. Then once we compress the chart to the barest minimum, we'll be able to see where the market has broken the trend line. Okay, so let's go to the chart, a real life chart. So this is a real life chart. This real life chart, I say compress it to the barest minimum. Now you can see the lowest point, you can see the highest point from here, right? And you can see the lowest point here. So this market has been moving this way. So let's push what's the best way to hide this thing? What's the best way? Let me see. This guy, I can't hide it. Okay, I just let me see it first. So the best, if we come to the top, this is the highest point that we can see, right? To draw the trend line, you pick this highest point, you stretch the line, extend it, and start moving it back into the chart. The first place where it touches the chart, you stop. That is your long-term trend line. This is your long-term trend line. Okay. Then from where it touches the chart, you pick another line from there, stretch it out, move it into the chart until it touches the first wick right there. This is your outer trend line. Okay. Then if you want to go further, you take from here and then you come back into the chart, down, and boom. This is your inner trend line. Okay. Is that clear? Let me compress this so that you can see it on the presentation. All right, so let's go back here. That what I just did explain this diagram. Okay, the long-term trend line, the outer trend line, and the inner trend line. We have drawn all three. We've drawn all three on this chart right now. Okay. Now, this was before this movement. Remember, this is when you are drawing the trend line, you are looking at the highest point and you're looking at the lowest point. Okay. So from the lowest point now, the market, you can still draw one more inner trend line here by picking this one. Okay. And coming all the way to this point here. Stop. So you see where the market breaks the inner trend line. The market hit this bottom, rock bottom, and then boom, it came back, break this trend line here. Let me zoom it out a little bit so that you can see. Break the trend line here, came back to test, move to the next inner trend line, break it, came back to test, and then it gravitates towards the outer trend line. It gravitates towards the outer trend line, even though it's not a straight line, but you see at the end of the day, it came to the outer trend line. So now, because this market, look at this. I said, if the market is not going to go, let's say the market break the line and it's not going to go. Once the market has broken this line, but the market eventually came back and closes below the line, you will move the line back to the top of this point. Okay, so this is your outer trend line. It has not changed. It's still maintaining. Now, even this one came back, hit it. Okay, you move it to the tip again of this one. This is your outer trend line. This is your present outer trend line. Okay. And you can see how it is guiding the market to the downside. Okay. If this market now comes and break this outer trend line, break this long-term trend line, it gives you a higher chance that the market is actually what? Changing direction. Okay. So trend line can alter your trading result. It can help you alter your trading result because it gives you that guide as to where is the market actually heading. Okay. So basically you come back. This is what we're trying to do here. You draw this up, you pull it out. I think I have a description for it already. Okay, yeah. So you pick the line, stretch it out, and then start moving it into the chart. So we did that for the long term. We did that for the outer, and then we did that for the inner. And then we'll now, try to wait to see where the market will break, will break the trend line. Okay. All right. So basically, once you can do this like this, you can be sure that your trend line is properly drawn. You can be sure that your trend line is properly drawn. And you see the market respecting that trend line. But like I said, like I told you guys on the last class, during the last class, this can be done automatically without you having to draw the line by yourself. So I have an indicator here that is called true trend line. Okay, true trend line. You just place it on the chart and say, okay, and it draws all the trend line for you, all the type of trend line you can think of. It draws all of them for you. So yeah, I have long term, long term, long term. Yeah, I have long term. So you see the long term from the up, you see the long term from the down, and you can draw it, any way you want, right? So I can decide to say, I want this trend line to be drawn across the body of the candle. I will come here, adjust this indicator. I want the trend line to be drawn on the candle body. And I say, okay. Now you see it's going to change a little bit. So now it's picking the candle body. Can you see? It's no longer on the wick. It's now on the body of the candle. Look at it. I can also apply the one that will give you the wick on top of it. So you have both the body and the wick at the same time. So you see, I have the one that picks the wick, the one that picks the body. And then you see the break. You see how the market breaks here, breaks the trend line. So some people can take this break as their entry strategy. It all depends on you. But like I said, don't do this. Don't just do it without considering the horizontal support and resistance. If you look at this place, look at it from here, the market has acted as a support here before. It became resistance here, and now it has come back here like a support. So if this place hold, this market can buy. If this place doesn't hold, the market will continue to sell. Okay? So I mean, to make your life easy, you can use the automatic tool. Yes, Prince, go ahead with your question.
Yes, good evening. So I want to ask, drawing the horizontal line, will it be at the tip, like the wicks, or the body? Like, where is the exact point that is good to draw those line? Probably after getting your trend line, say you want to add more correlation to the whole chart by drawing your support and resistance. Is it at the wick or the body of the candle? Where is the best point?
Okay, so the way I look at it is this. Okay. Now, remember, you see, this is price. This price is a very tiny, thin line, right? Very thin line on the chart. But when we talk about resistance and support, we talk about eye of resistance. When you say eye of resistance is here, is this tip, this wick. But when you say resistance, is this body. Now, the distance between the body and the wick is the zone, is the resistance zone that we call supply zone. Okay, so for every candlestick you see here, where you see that the market has created a bearish candle and immediately followed by a bullish candle. Remember, you see, I have bearish, I have bullish, 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 bullish. It's different from when I have bullish followed by bearish, bearish followed by bullish. When you see a bullish candle that is immediately followed by a bearish candle, it is a resistance. When you see a bearish candle that is immediately preceded by a bullish candle, it is a support. But the low of the support is the wick. The high of the resistance is the wick. Does that make sense? This one is not on a textbook. You will not find this one on a textbook. I'm just explaining it. It's a concept, right? But I don't think it's written on any book. I've not seen on any book. So you know when the market is moving, the market move more like in a slanted position. It continues to go slant. If the market is trending, the market will go in a slant position. But when you see the market now forming a block shape, it's telling you that, oh, something is happening, the market is stalling, something wants to stop something. Okay, so me, I look at the chart critically on my own, and I came up with this idea. And I say, when you see a bullish candle that is immediately followed by a bearish candle, is a resistance. And when you see a bearish candle that is immediately followed by a bullish candle, is a support. Because if it's not going to be a support or a resistance, the market will open from the close of the previous candle and continue to move. And there's a phenomenon in this market that is not very popular, many people don't know about it, is that if the market is moving, the market is successively closing above the open of the previous candle. What do I mean by that? If this market is going to buy, this next candle, the close of this candle, can never be close to the opening of this candle. And when the market continues to do that, it will continue to buy. But whenever the market closes below the opening of the previous candle, it has changed direction. Now, because in your smaller time frames, like your daily time frame, because you have many candles, right? If you switch this thing to weekly, for instance, or switch it to monthly, or switch it to yearly, you will see. Imagine this. Let's take this place, for instance. Look at this place. This market formed this as resistance, right? And then immediately it formed this as support. And immediately it formed this as resistance. Now, see how this market dropped all the way from this place. Why the market dropping all the way from this place? Because if you look to the left here, you will see what? A previous resistance that is holding. Previous resistance that is holding. In the concept of the market, this is called counter trend. What this phenomenon? A phenomenon whereby the market creates a high like this. Okay, this is a high, the body of the candle, and the market comes back to that high, but this time the body of the candle could not get past the high, but the wick touches that high, touches the body of the previous high. It is called counter trend. Now, this market gives you the wick, kiss the body of these two candles, and then it gives you a dark cloud candlestick formation. This is not going to make sense because this is not a candlestick formation. This is not a candlestick formation, but this one is a candlestick formation. This bearish candle closes below 60% of the previous candle, and that makes it a dark cloud candlestick formation. So, because somebody will ask me, oh, this one is a bullish candlestick, and this is a bearish candlestick, and this is a resistance. So why did it not sell? I just gave you the reason, because this is not a candlestick formation. This does not drive the market. What drives the market is a formation. But this one is a formation because it closes below 60% of the previous candle. I shared with you today. Here's my WhatsApp. WhatsApp. All of you on the group. I shared with you this morning, right? A bullish candlestick formation, right? The most occurring of the bullish candlestick formation. And then the most occurring of the bearish candlestick formation. This is bullish, this is bearish. Now, this candlestick that I'm telling you now, that I'm showing to you now, look at it here, is this formation, this one. Dark cloud, where you have the bullish candlestick and then immediately preceded by a bearish candlestick that closes below 60% of the previous candle. That is a dark cloud. And that is why you see this market drop for how many months? From here, let's say you pick this market here, sell. The market dropped for 13 months, 1 year, with 2,364 pips. 1 year. How will you feel? You place a trade, you go to bed for 1 year, that trade is still making profit for you for 1 year. Is it clear now?
It's clear.
So you have the option of picking the wick, you have the option of picking the body, but my advice is to pick the body because the wick now, okay, let me also explain something to you about the wick. The wick is a tool that the broker can manipulate. The wick you see on broker A is not the same wick you will see on broker B. Maybe broker A, the wick is longer. Broker B, the wick may be shorter. Do you understand? So because of that, you cannot rely on the wick, but you can rely on the candle body because the candle body determines the volume. See, when I put the candlestick, when I put the mouse on the candlestick, look at what is showing you on the volume down. Come to the down right of my chart and see volume V. V, your V is not showing. Let's see. I think something is wrong. The V is not showing. Okay, so your V will show you the total transaction that happened on that candlestick, right? That's the volume. Now, the broker may not be able to manipulate that, but the wick is easily manipulated. And imagine that you are drawing support and resistance and you are using the wick. And on broker A is telling you that the wick is coming from XYZ price point. And on broker B is coming from, broker A and broker B, the difference in wick can change the direction of your trade. The difference in the wick can change the direction of your trade. But you see the body will hardly change. So I strongly recommend that you rely more on the body when you are considering your support and your resistances. And one way you can also determine resistance is when the market moves away from the point. So the market came here, and when the market got here, it moves away. So this is a resistance. Now, the next time the market comes there, you are thinking of two things. Is the market going to break that resistance, or is that resistance going to bounce the market back? In this case, it bounced the market back because before the market actually go with a big candlestick, a strong candlestick with the intention of breaking that resistance, but it didn't break it. Instead, it came back with a candlestick formation that gives us a dark cloud pattern that causes the market to drop down. Now, in the same vein, this place is a resistance. If you look at this body, it's a resistance. The next one is a resistance. Okay. Now, look at these two scenarios. The market came here, move away. The market came here, move away. Now, the market came back to this same area with the wick touching this candle, and then the market gave you a bearish candlestick formation, a bearish engulfing candlestick formation. This is the reason why this market fell. The market gave you bearish candlestick. Now, maybe some person, very aggressive persons, would have entered this market here. And then the market will do 1, 2, 2 months against you. If you have so much money and you are able to put your stop loss above this high, then this will not bother you. But if your money is not too much, by the time this market is doing this 2 months against you, I'm sure your BP will change. Okay, you may want to close your trade. But then after all this, pushback to retest this level, the market eventually came down all the way. And even if you take it from that aggressive guy's position, you see the market still came down with that's about 1 year, 18 months. 18 months is about 1 year, 6 months, okay, of trade. Now you are seeing 1 year because I'm on the monthly time frame. If I switch to smaller time frame, you will not be hearing 1 year, right? You'll be hearing days or hours. Okay, so it depends on the time frame that's comfortable with you to trade. But everything that the market is doing It's taking reference from the monthly, it's taking reference from the weekly, and then it's taking reference from the daily. Okay. So without wasting much time, let's just go down. So this is just to show you how we draw the trend line. We pick it, we stretch it, we move it back to the chart. It touches the wick, we stop. We go to the next one, pick it, stretch it, move it to the chart, touches the wick, we stop. And then we go for the inner, the same thing. And then we wait for the market to break. Okay. So that basically shows you how we draw the trend lines. Okay. So anytime you hear trend line in the market, don't be scared. So this is how we draw them. Okay. You see this one? That's the long term, and this is the outer trend line, and you see the market has already broken it. And when the market breaks it like this, we expect the market to gravitate to the next trend line. Okay. Now you see how the markets. Now this is like a sorry. Let me go back. Sorry, 1, 2, 3, 4. Yeah. So after the market, this is a long-term trend line, and we expect that when the market hits this line, there's a chance that the market is going to sell down. Okay, that's what this person is trying to. Thank you. Yeah. All right. So this completes the trend line discussion. Any other question on trend line?
No question from here for now. Thank you, sir.
Okay, so let me quickly go to where we are supposed to continue from today, and which is Fibonacci retracement and extension in an uptrend. All right. So in an uptrend, we say the market is creating what we call higher highs and higher low. The market moves by creating higher highs and higher lows. Now, we already talked about Fibonacci, right? And if you can remember our discussion in our last class, we said the market, when the market is moving from point C to point D, the market will, evidently come from 5 critical levels. And these 5 levels are the 38.2% level, the 50% level, the 61.8% level, the 78.6% level, and the 86 or 88.6% level. And each of these levels have their corresponding extension. So the levels are right here, right? You usually don't see them with your naked eyes, right? But you see them with the tool, with the Fibonacci tool. So when you pick the Fibonacci tool, and irrespective of the chart you are using, whether you are using MetaTrader 4, whether you are using TradingView, whether you are using SmartView, any platform you are using is the same. Okay, so this is the Fibonacci tool. Okay, so these lines, they are more like, they are there, but they are not visible. You are not seeing them, right? So when they impact on the market by, causing those changes, if you don't have the Fibonacci tool that has, that you have placed and estimate that region for you, you may not know. So what it means is that whenever the market is coming back, when the market has moved A to B, and the market is pulling back into the A-B boundary, essentially, you want to take cognizance of these levels. Because when the market gets to each of these levels, if the market is going to change direction from that place, the market will give you a candlestick formation. So the market gets to 38.2, gives you a candlestick formation, it will buy. 50 gives you candlestick formation, it will buy. 61.8 candlestick formation, it will buy. And when it hits any of these three as it's buying, it will buy until it gets to 161.8 level. If it hits the blue level and is buying, it will buy until it gets to 1.27 or 127% level. And if it hits this green, it buys until it gets to the 118 or 1.18% level. Okay, so we talked about this, and this just an expression of how it looks like. All right, so today we are going to see that in this boundary, there are 6 different ways the market retraces into the boundary. There are 6 different ways the market extends out of the boundary. So so this will probably clear some of your doubts as it relates to, the drawing of the trend line too as well. Because you see that, oh, you have drawn the trend line, but all of a sudden the market comes, took out the trend line and again went back into the trend line and went, down the more. So this is one of the reasons why that happens. So these are the six conditions. Yes. So the first one is what we call the super shallow retracement. The second one is the shallow retracement. The third one is the D past 5-0 shallow retracement, and then we have the deep retracement. The previous two are called deep retracement. Then we have what we call the whipping nasty retracement. So when the market is coming back into this level, these are some of the ways you will see the market come back. Sometimes it will not even get to the 38.2% level. The next thing, the market will just take off. In some cases, the market will first of all attempt that is coming back, and you see the market break past the B level. Now it's breaking past the B level, but it has not gone to, to create a high that you will consider. Okay, so let's put it this way. In a flight, there are turbulence, right? But among the turbulence, some are stronger than some. Some turbulence are minor, some are major, right? So if you look at it from in that perspective, this movement here that this market used to go out of this is more like a minor turbulence. So it means that the market has not really gained that, necessarily gained that ability to start extending to the D. So the market pulls back into the AB boundary. Okay, and then it hits the C from any of these levels, and then it extends. While there are instances where the market will just come immediately create B, it will come straight down to 38.2 and it buys, 50 and it buys, 61.8 it buys, 78.6 it buys, and then 88.6 or 86 it buys. This one is just like a straight line. The market will just come like a straight line, bam, 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 hit any of these levels and it buys. While in some cases, it's going to do a sub A, sub B, sub C, sub D, and then it buys. Now, it can do this sub A, sub B, sub C once, like in this case, the first deep retracement, which is what we want. As traders, what we want is when the market gives us deep retracement. We don't want shallow retracement, because shallow retracement means that my stop loss will be very big. Remember, your stop loss has to be below the A. If I'm going to set a stop loss from year to year, it will be too big. The same thing for this guy. But you see, when the market comes to the 86% level, we love it because our stop loss will be very small and we expect a massive profit. Okay? So when the market does this, it gives me A, B, C, D. Inside the AB boundary, and then it gives me a C, and boom, we'll take the trade. We'll go to D. Okay. Now, in some cases, instead of the market to give you A, B, C, D, and go, the market gives you A, B, C, D. A, B, C, D. A, B, C, D. It can even do it 10 times, but in a very small range. Okay, that's what you're seeing here. And then the last one, which is the most frustrating of all. But if you are able to wait and take the trade, your stop loss will be very small. Your take profit will be very big. Is the whipping nasty, where it's not just going to do A, B, C, D. It's going to do something nasty. Okay, no direction. It comes pam, 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 A, B, C, D, A, B, C, D. All the A, B, C, D is doing is confusing. But you as a trader, your target is these 5 levels. 1, 2, 3, 4, 5. Is the market within this 5 region? The market has not gone out of this region. The market comes, let's say when the market created this, you thought this was the C, you buy. You put your stop loss below the A. It created it, you thought this was the C, you buy. You put your stop loss below the A. You thought this was the C, you buy. You put your stop loss here. Eventually, it came out and gave the last C. And after that, boom, it moves to D. These are the 6 different ways the market will move from what we retrace into the AB boundary. We also have 6 different ways the market extends into the AB boundary. But this is just to show you each of those ways. This is the first one that we'll talk about, shadow. This is a market that depicts it. Okay, so you see, it didn't really come back to 38.2. less than 38.2, and then the market takes off. This is an example of it. This is an example of the one that first of all run out and then came back into the AB boundary, and then it rallies to your D. Okay, that's the second condition. Then the third condition is when the market just goes straight to each of those levels and buy. Okay, the market just come to 38.2 and gets a candlestick, it buys. 61.8, it gets a candlestick, it buys, just like that. So it comes back to each of this level and immediately run. Okay, and then the third, the fourth one is when the market comes back into the AB boundary, creating sub A, sub B, sub C, sub D. As you can see here, small a, small b, small c, small d. And that is your C. Your small d is your big C. And then the market gives you a piercing line. Now look at this candlestick. This is the opposite of the dark cloud that we talked about. The opposite of dark cloud is the bullish version of dark cloud, and it's called piercing line, where you have the candlestick closing above 60% of the previous bearish candlestick. And then we have this, where it has to come back with ABCD multiple times. And then it finds a final big C. So your A, B, C, D, then the market goes. All right. And then we'll talk about the whippy nasty. Yeah, the market can stay here for 1 month and you are waiting for the market to buy. Maybe you have already taken the trade here. Maybe you've taken the trade here. In as much as you have equity to hold the trade and the market does not go below the A, the market has no choice than to go your way. The market will go against you, and eventually the market will go your way. All right, so this is the whipping nasty way. All right, so also we have 6 ways the market leaves the extension, the retracement level to the D extension. Just similar to what we have on the retracement, we also have 6 different ways, and these are the 6 different ways. The market comes, hits the C, irrespective of whatever way, whatever pattern it hits the C. After hitting the C, the market wants to go to D. In some cases, the market will just go to D on a straight line, right? It came here, hit the C, boom, it takes off. Came here, hit the C, boom, it takes off. Came here, hit the C, and it goes A, B, C, D to take you to your D. Yeah, the same thing. It came A, B, C, take you to your D. Yeah, give you A, B, C, A, B, C, A, B, C, A, B, C, take you to your D. And this is also the whipping nasty pattern of extending to the D. So all these options, you see, they are examples on how it's portrays on the chart. Okay. So what does it tell you? It tells you that sometimes you need real patience, to allow the trade. Your analysis may have been correct, your analysis may be right, but because you're not patient enough to stay on the trade, you jump out of the trade and you come back after like 1 week, the market has gotten to that place that you estimated is going to get to. So you need to be very, very patient with the market. You do the analysis, wait for the analysis to play out. Okay. All right. So finding the A's and adjusting the ABCDs. So what we talked about is simply, we've explained it already, but let me just throw some light to it. Okay, let me take it back to price swing. Okay, sorry. Oh, I guess this is the guy that is disturbing me. Let me close it first. Close this guy. Okay, so we talked about adjusting the A, B, C, D. Yeah, so this is your A, this is your B, this is your C, and this is your D. I said when the market has created your A, your B, your C, and your D, what you will do, this your C is just like that adjusting is talking about. It's like tying a rope. Sorry. It's like tying a rope on this A. Okay. so that on this A and this B, so that when this market gets to D, you will drag B to the position of D. When you drag D to the position of B, automatically A will take the position of C. So now your C and your D, their job is completed. You take it out. And then you now come to A, B again. So you now start the wait again for the market to come back to C. And when the market comes back to C, you now look for a trade from the C position by waiting for the market to hit any of the Fibonacci retracement level, and then you can now take your trade from there. Okay, so what to do? You locate and adjust the ABCDs in an uptrend. So like we say, if the current market is making higher highs and higher lows, compress the chart, find the downtrend line that is broken, and then locate your A. Okay, then draw a horizontal line, lowest low, and put above the A. So then decompress the chart and find the lowest low with the horizontal line. That will be your starting point for your up ABCDs. Then follow the candles up to the first high until there are two candles to the left and two candles to the right that are lower than center week high, and that is your B. Then you draw a horizontal line there. So that gives you your AB boundary. Okay. So just like I explained previously, this is just the talking point on that explanation. All right. So the 5% rule. The 5% rule applies when we project. So the D that you are planning to get to, we call it projected D. But when the market finish running to that point, we are going to have what we call the actual D. So in most cases, we find that sometimes the market will just be a pip or two less than the projected D. And that will make you to miss your profit because you have set your profit at your take profit at the projected D. And then the market come very close to it, but didn't touch it, and then the market goes back. So what we did is to say 5% true. So we'll set the projected D, we'll set it like 5% below the Fibonacci level. So if the Fibonacci level is 161.8, we won't just put it at that 161.8, we'll put it like 5% below it. So that whenever the candlestick comes there, it's going to hit it first before it attempt to run back. Now that's not 100% foolproof because the market can decide to go back 10% below the Fibonacci level. Okay, or sometimes it goes back 10% below the Fibonacci level, and then the market does what it's going to do and come back up again and go all the way to the projected D. Okay, so the 5% rule is just to enable that you don't leave any pip on the table so that the market does not come close to your take profit and then it goes. So we have our D. Yeah, so this is just an example. Okay, so this is your D. This is your actual D. This is where the market actually got to. Okay, but then your projected D can be different, okay, from your actual D. So this is your actual D. You see, in this case, this is your projected D. Your projected D is the Fibonacci itself. But you see your actual D, it went a little bit higher, okay? There are instances where also the actual D, look at your projected D here, okay? But see your actual D, it's a little bit lower than the projected D. So if you have set your take profit here, and this market come here, these few pips, the market will turn and you will not be in the profit. Okay, so that's why we need the 5% rule. So we do some extra calculation. So instead of setting your take profit right here, you can set it 5% below this level and bring it to somewhere here. And in a case like this will still put you in profit before the market, go the other way. Okay. So that's it. I think anybody have any question? So this is just drawing the uptrend line. We've taken this one already, so there's no point running through this one. Question, any question? comments, question before I show you the last thing before we close this class?
I think it's been well explained. It's beautifully explained, crystal clear.
All right, thank you. Anybody that has any confusion? Maybe you are new and all these things are new to you. Do we have people like that here? All right, so having done this, so let's switch back to our trading platform. So this is our trading platform, and like I said, you need to go and take time to understand it very well. Okay, take time to understand it. It sometimes it could be frustrating. I won't lie to you, it could be frustrating, but trust me, once you know it, you will find out that all the frustration is worth it. Okay, so everything you see here has a job. They do everything you see here. Take your time, go and learn it. Go to YouTube, go to anywhere, you will see a lot of them, a lot of videos that explain how to use this. But yeah, our primary aim is to see how we can take advantage of the platform. So here in this platform, I'm sure you can see M1, 1 minute, 5 minutes, 15 minutes, all the way to 1 month. Okay. So this chart, this is daily chart. This is the same currency for 1 hour chart. This is the 1 hour chart version. This is the 30 minutes version of the same chart. And then when you press Ctrl Y, it will break the chart, with broken lines for you. So each of these broken line, like for instance, let me come to 1 hour. Each of this broken line tells you the space between 1 day. Okay, so between year and year is 1 day. So if I switch this to 4 hour, the space between year and year is 1 week. If I switch this to daily, the space between year and year is 1 month. I don't know if you are getting me. So from this broken line to this broken line is 1 month. Okay, so this is 1 month of this market buying. And now this is another 1 month of this market selling. Okay, so you can tell what the market did the previous month, and just like that, you can tell. Okay, so that's that. Then if you want, if you take away the separator, you can put the grid by pressing Ctrl G. Now, a lot of people don't use it, but you feel like using it because you want to see the actual line of your price level, you can use it. It doesn't make any difference. Okay, it doesn't make you successful at your trade. Okay, it's just a tool. All right, so I prefer it when it's plain. That's me. Then these candlesticks, you can change the color. For you to change the color, it's either you press F8 or you right click on your on your on your mouse and come and click properties and click colors. So the candlestick that is going up is the bullish candle. The one that is coming down is a bearish candle. So I can decide to say I want my bullish candle to be blue and I want my bearish candle to be red. When I do that and I say okay, you see the color has changed. So when the market is going up, I'm seeing blue. The market is coming down, I'm seeing red. So don't be carried away when you see different color on people's charts. You can change it and you can decide to even say, I want everything to be one color, both down and up. I can say I want them, both of them to be blue, everything blue. It's my chart. Nobody will come and query me. My chart. Okay. You can see that. So you can manipulate that yourself. It's not a big deal. Then once you are comfortable doing that, then you tend to apply what we have taught in terms of knowledge to the chart. Okay. So this is NZD/USD. Let's see other currency pair. So let's see. So this you have this is so this broker is Deriv. Okay, the name of this broker is Deriv, and they have volatility indices. They have so if you come here, you will see everything they have, right? Step indices, boom and crash, volatility, range break, basket indices, metals, forex, major, minor, energy, so stock, everything they have is here. Okay, so you can decide to trade. So they have, I think, about 200 and something assets here that you can trade from. Okay, I like them because I don't have to have a separate account for volatility separately. I have one account that I can do all this at the same time. Okay, so if you go to uh if you go to your phone and you just install MetaTrader 4, if you just go to your phone, install MetaTrader 4, you will see I think it will automatically create a demo account for you that you can use to trade. But then in your computer, you want to go to MQL5. I think we talked about it in the last class. You want to go to MQL5. This is their website. MQL.com, MQL5.com. That's the website. So if you go to the website, scroll down to the bottom of the website, you will see oh sorry, let me go back to their main page. So MQL5, click on MQL5. So you come here and scroll down to the bottom of the page. You see MetaTrader 5 trading platform. You click on it, okay, and look for download. So here you can download for Windows, you can download for Apple. So here for Windows, you click on download for Windows. This I'm showing you now, this is generic. This is not tied to any broker, right? This is not tied to any broker. So this one is a general MetaTrader 5. So if you come here and you click for Windows, okay, and then you click download, it downloads for you. After it downloads for you, you install, okay. So let's see, MetaTrader 5. I think it has downloaded already. Let me see. So you go to download, see programs, MetaTrader 5. So we'll run the setup. I'm just doing a demo for you. Okay, no, I'll be able to run it on this computer. Okay. I need Jobless IT to give me access. So I'll be able to, but when you run it, when you finish running it, it's going to come up with let me see if it will work. It's all that is say install. Okay, let's see. Let's see it. Okay, so when you install it, this is what you see.
Incoming mail.
When you install it for the first time, this is what you see. I hope you guys are taking notes for those of you that have not done it before. So this is your MetaTrader 5 page, right? Now it has automatically created a demo account for me already. Look at it. Look at the demo account. Look at the number 83617372. So everybody that has not done that before, you can do it yourself. Okay. And then it's a $10,000 account. Look at it, $10,000. Okay. Now This this uh this place that you see here, this place is called the market wash, and this place is called the navigator. These are one of the two most used aspects, okay, of this MetaTrader 5. So in this market wash, I can take it out, right? And I can take it in. So the shortcut to taking it in and out is Control M. Control key plus M will close it. Control key plus M will open it. While for the navigator, Control key plus N will take it out. Control key plus N will bring it in. Then for the toolbox, look at this place. This is called the toolbox. This is where you see your running trade, your balance, your equity, okay, your margin. Control T will take it out. Control T will bring it up, okay? So these three items, I'm not seeing them here right now, but I can decide to put them here. In order for me to put them here, I'll right click on anywhere here, okay? So now I have tools, I have line tools, I have time frame. So you can move it. If I click on this thing here, I can move this time frame to the end if I want. It depends on what you want. I can move these tools to somewhere before the time frame. Okay. Anywhere you want to put it, it's up to you. So now I can come here, right click on anywhere here. These tools, don't right click anywhere and say costume. When you click on this costume, I want to bring the navigator, the market wash, and the toolbox. I want to bring them here, including templates. I want to bring them here so that I don't need to be doing control and all that, right? So, and I want them to start from where I have the new order. So I'll come here. Where you want to insert it, you need to indicate the point. So I want to, okay, let me insert them after the candle bar. So I'll take the bar and I say, anyone you click and you say insert, it will come to this side. Now you can see navigator has entered there. If you click market watch and say insert, it will come here. Market watch has entered there. If you click toolbox and say insert, it will come there. And lastly, template and say insert. So I've inserted 1, 2, 3, 4. Okay, so because I need them, so I close. So yeah, I don't need to go and be doing Control M and all that. I'll come here. If I want navigator, I click here, navigator will go. If I want market watch, I click here, market watch will go. If I want toolbox, I click here, it will come out and go. If I want template, I put this down. All right, so on the market watch displays all the tools, all the assets that's available for you to trade. So if you right click on market watch, now when you download it for the first time, it will not show everything. Like you see this one, it's showing 140. It's showing 10 of 140. For you to see the entire 140, you come to anywhere on the market watch, right click and say show all. Click on show all and it will populate everything for you. Okay. So if you don't want to see this daily channel, all you need to do is just right click and come to columns, then look for daily change and select it out. Now it's gone, it's no longer there. Anything you want to see, you can put here. Anything you don't want to see, you can take away. Okay. All right. So these are the things, these are the default templates that came with the system. So if you come here, these are the default template, ADS, Bollinger Band, Momentum. These are default templates. Okay. So once you select each of them, let's say for instance, I open this chart and I come here and I select ADS, that chart will change to the ADS template. If I come here, select Bollinger Band, it will change to Bollinger Band template. If I come here, select Momentum, it will change to Momentum template. These are default templates that come with the chart, okay? You can create your own. You can create your own template and say, okay, let's quickly create one template. Let's say, first, for me to create, I want to show you how to create a template now. Now, let me take ADS, okay, because nothing is there. So, Right click this, delete this. Now I told you when you put the grid, it doesn't look too good, so I don't use the grid. So it's just Control G. Control G, take your grid away. Control Y, take your comma separator away. And then there's a moving average there. I can delete the moving average. All right, so I want to create my own template now. First template, I've opened the system. This is the first template I'm creating. So I come here, I want to create a trend template. So I come to indicators. These are the indicators that come with the system. These are default indicators. So let's go to trends. So let's use moving average. So let's say moving average 21. I take 21. Okay. Exponential. All right. And I say the color. Let's say the color is white. And let the thickness be thick. And I say, okay. So that's moving average 21. Then I put another moving average. And I call it 14. Okay. The same exponential. I make it a little bit thicker, okay, thinner than the first one. Then I say the color is blue. Moving average 14. Then I come here and say moving average 7 or moving average 10. Next one, change the thickness, change the color to red. Red. Okay. And then the last one, I say moving average 7. All right. Change the color to tiny and give me gold. I say, okay. So this is my template. Now this template, I'm not going to save it. I'll come to this. Remember, I added this to template. So I click on this template, click on save, and I give it a name. Say ZipatFX trend trading system. So this is a trading system. Then you say save. Now as I save it, anytime you come here, that trading system is there. If I say, I click on it now. So even if I go to any of these charts, this original chart that came with it, and I say, okay, apply the Zipat template, all I need is just come here, click on it, and it changes. Okay. So now, this template I've created, what is it telling me? If the moving average, so there are four moving averages. I have the 21, the 14, the 10, and the 7. When the 7 comes from bottom and crosses above all of them, so a good example is this place. You see, 7 is at the bottom, the gold. When this gold comes and crosses all of them, close above all of them, and then all of them are now parallel to each other, I say the market is what? Is buying. If this gold comes from the top, closes above all of them, okay? Closes below all of them, and all these four becomes parallel, I say the market is selling. That is the trading condition of this my system. Okay, that's what I've set as the trading condition. So all you need to do, you can use it on any time frame. Okay, now it's on 1 hour. Okay, I can say give me on 4 hour. I can say give me on daily. So it depends on you. So now I see the gold come from the bottom, crosses above everybody, and it's now up. And then all these lines are now parallel to each other. It tells me the market is just going to start to buy. From anywhere here, I take a buy, and then I come and put my stop loss below this low. Does that make sense, anybody?
Yes, sir.
Yes, it does. A lot.
Okay. So
how do you create your condition? Because it's the condition that you've created that help to bring all these charts, all these trends forward.
did you see when I was putting the lines?
Yes, I saw them.
Are
Okay.
those standard conditions? Are those? Is there any criteria for those conditions you imputed?
Okay. So the criteria is this. How many of us have heard that when the market breaks the trend line, it will come back to test the trend line?
Yes.
Yes.
Okay. All right. So see your moving average. This your moving average is acting as a trend line. These lines, okay? All these 4 lines, they're acting as trend lines. Now the market breaks above all this trend line, came back here and test them. It did not break below them. After this test, you can start to buy. And then let me give you another example. Look at this point. Okay, I probably need to make this thing thick so that you see it. So I increase the thickness of this line so that it will be visible to you. All right, and then of the horizontal, because this is a new system, and make it visible to you. So you can change the color. Let's make this one good. Okay.
You know, my question is the numbers you imputed, like those 7, 20, 14, are they standard numbers using your moving average
Yeah,
line?
okay, so I'll answer that now. All right. In one of our class, I told you that the most important tool in this forex market is your candlestick, right? Now, this candlestick, I can also create another template. Let me create another template of this one. Just take this out, take all the moving average out, and out. And then I say, save this as a plain chart. I can save this and give it a name, say ZipatFX plain chart. Delete all this. Okay, and say save. So now I've created 2 templates, remember? So if you come to template, you're now going to see ZipatFX plain chart. Now, this plain chart, I can switch it to line, right? See line. I can switch it to candlestick. I can switch it to bar. Now, I want to switch it to line and show you something. I'll now apply moving average 1. I want you to see something. Moving average 1. Change this 7 to 1 and say, make it big and say apply. Did you see anything?
Yes.
What did you see?
Like it's superimposed on the graph itself, on the line itself.
Fantastic. Now, what does that tell you? It tells you that this candlestick is moving average 1. Can you see that?
Yeah, that makes sense, yeah.
If I change this candlestick to line, look at it, it's moving average 1. I can take away my moving average 1 from the chart. I can delete it, right? Delete. Look at it, your line. It's exactly moving average 1. Now, so what does that tell you? That tells you that all this struggle that we are struggling in the name of we want to trade this market, this candlestick we are talking about is just a moving average. All this candlestick, all the noise they're making in the whole world, the candlestick is a moving average. So now, what is a moving average? A moving average is, so when you hear the number 1, the number 50, the number this, okay, it's actually with respect to time. Okay, so I can say there are 3 most popular moving average in the forex market, and they are moving average 14, moving average 50, and moving average 200. Moving average 200 divide the market into buy and sell zone. Okay, we have not gotten to indicator trade class, but I just use this to explain to you. Moving average 200 divides the market into buy and sell zone. That is, whenever you see the market above the moving average 200, the only thing that you should be thinking in your head is to buy. Don't think of sell. because any sell you are going to see is going to be a short sell. A good example is this sell. It's a short sell, short sell, short sell, short sell. And anytime you see the market selling, you are going to draw what we call counter trend line. I'm coming. You are going to draw counter trend line. Okay, that was a counter trend line. A trend line against the trend. Okay, so yeah, look at here. Let's see where the moving average started coming from down. Okay, all year the market is above the moving average. Okay, so when the market came down like this to this moving average, what you will do, you will draw a trend line like this. Draw a trend line like this. Okay, this trend line is against the trend. When the market breaks the counter trend line, what will you do? You start to buy. Like here, break the counter trend line from here. All this would have been your profits. Okay, and then the market did this. You draw another counter trend line here. The market breaks this, you buy. You draw another counter trend line here. The market breaks this, you buy. And then another one can also be drawn here, right here. Market breaks it, you buy. So all your counter trend line are your entry. But don't worry, this class, we still have some time to go. By the time we get there, you understand all this. See, trust me, by the time we finish this series, if you don't know how to trade before, you must know how to trade. Okay. So this number, coming back to your question, you can choose anything. There's no hard and fast rule to choosing the number. It's just that I choose what I'm choosing because over time I've used it. Okay, and it has produced results for me. So let me put the next popular moving average, which is 50, and then 14. 14 or 21 is fine. Okay, so these are the three most used, right? But everybody has what they use. And trust me, you cannot be wrong with the moving average. You cannot be wrong with the moving average. So why this one? Why this one? I can decide to say, okay, I just want to use only two moving average. Take out this 50. Okay. You see that I want to use 50, I want to use 14, it doesn't matter. But let me just take out one. Now, one of the moving average is now like is the one that is acting as a counter trend for you. So the market comes down all the way to the 200, and then the market breaks 50, you start buying. The market pulls back, breaks 50 again, you start buying. Pulls back, break 50, start buying. Pulls back, break 50. Every pullback that the market pulls back and break above the 50 moving average in the direction of the 200 is a buy trade. It's an opportunity for you to buy. I don't know if it's making sense to you guys. This is
Too much sense.
what I'm showing you now is a strategy. Okay, it just
Too much sense.
for instance, this is 200 moving average. This is 50. This is 14 moving average. This 14 moving average, the market is pulling back and breaks below it. Now the market did not get to 200 and now breaks above 14 again. Take a buy from here. The next time the market breaks below 14, close your trade. Wait for the next time it breaks above 14 again, take a buy. When it breaks below 14 again, close your trade. You wait and wait, it breaks above 14 again, you take a buy. Just keep buying until the trend will break. When will the trend break? When the 200, when the market breaks below the 200. This was the 200 sell. This was the 200 buy. So the 200 is the major separator of the buy and the sell zone in the Forex market. Capiche? So if you come back now, this my template now. This one, ZipatFX trend trading. You can superimpose this now on top of 200. So you now add 200 to this chart. You add moving average 200 to this chart like this. Say 200. Okay. Let me move add 200, 100, and 50 for you so that you can see both the long, the medium, and the short-term trade. 50. All right. So this my template, this my multicolor moving average, they are my trigger to buy. So the market pulls back in this case to 50, 100, didn't get to 200, and 200 is telling me the market is buying, and then the market comes back and break above all this my collection of moving average. You take a buy from here. It's either you want to buy from here aggressively, or you want to wait for the market to come back and test this set of moving average, and then you buy. You see that? So if you scroll back in time, you will see the places the market has given. Look at this. The market pulls back, breaks above this, came back, tested, break above this. You take a buy from here, the market run all the way. Look at this one. The market breaks everything, pulls back, come back and break above all this. Take a buy from here, market run. So it makes the indicator makes your trading entry easy. Look at this one. The market pulls back and then breaks above this, take a buy. Okay, just like that. Okay, so you can probably go to your own computer, and this is a demo trade. Okay, you try it on demo. Make sure you try it. One thing I like students to do is to try it. All right. So lastly, before we close this class, my time is up, but let me just show you this before we close this class. So I told you that join this class because there's something I want to show you, and it's really, really interesting. So the knowledge we get in Forex, I've always said that you can use it across, several stuff as far as this financial market. Now, some people, they do spread betting. Some people, they do, a lot of things. In fact, some of these companies, they started with spread betting. Some started with gambling. But today, they are big companies that run the Forex market in this world. Okay. So there's a compound formula I want to show to you. This one is, don't think about it so that you don't lose your sleep, okay, about it. All right, so this one, what I'll do is, so it's a formula. So this is a formula. So if you look at this formula, I have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So it means that I have to take 10 trades. And now when I take this 10 trades, it is compulsory that I must win the first trade. Okay. It is compulsory, I must win the first. So I tried it for different brokers because each of the brokers, they give different return in terms of the percentage profit. Okay, in terms of the ROI. So this guy gives 94% of the ROI, meaning that if I put the trade with $25, when I win the trade, what the broker will pay to me is $23.55. Okay, so now I've set a formula. And this formula is that, let's say my account is a $100 account. And I decide to take a risk of 5% of my account. 5%. Let's even try 2%. 2% of my account. Okay, I take a risk. Now, if I take a risk of 2% of my account, and I did not lose any trade. So I trade all this trade and I win all of them. I trade the first one with $2. This is 2% of $100. The profit I make is $1.88. Now my next investment is that profit. So even if I take this trade to the sixth trade and I lose, I will not lose a dime from my $100. I don't know if you're getting me. If I take all this trade 1, trade 2, trade 3, even to trade 10, let's say I win up to trade 9 and I lose trade 10. This $100 will still be in my account. The only time I will lose from this money is if I lose this first trade. I put this first trade and I lose it. That's the only time I will lose from this money. So this is just this. So I just want to show you how powerful this compounding formula works. Now you can use it on Forex, you can use it on stock, you can use it on anything, you can use it on volatility, stick and everything. So I have a broker, and that broker is called this broker, right? So apart from trading this chart like this, we also have the option of trading this chart in another form that is called tick. Okay. Another form that is called tick. Now, with this tick, look at this money you are seeing here. This is real money, it's not demo. Okay. Last Friday, I put $1,000 in this account. And between Friday and now, I've made $800 on top of the $1,000. Okay. Now, how do you do that? Everything you see here is a trading platform. This is a trading platform, the Retrader, the Reboot, the Go. So I prefer the Smart Trader. This was called Smart Trader. This is the one I use. Okay. In this Smart Trader, I'll just do an example for you so that you see. So you can select what you want. So you can now, in this case, this is, I want it because a lot of people call it gambling. But trust me, if it's gambling, I cannot move $1,000 to 1,080 in 2 days. If it's gambling, I would have lost this money. Okay. Now I want to show you the reason why it's not gambling. And that's one of the reasons why I said the knowledge you get in Forex, you can use it on various platforms. Okay. So I prefer to do 5 movement. Okay, 5 movement is actually 5 seconds. So when you place a trade, I want you to see the condition here. This is the condition of the trade. So you can either purchase high or purchase low, or buy or sell, right? These are the conditions. So look at the trade. When you enter the trade, from the point where you enter the trade, if you say the market is going to buy, it means that by the time the market will close, it should be higher than where you enter the trade. If you say the market is going to sell, it means that by the time the market closes, you should be lower than when you enter the trade. So there are 2 ways to look at it. One is looking at this thing that looks like worm. This worm you are seeing is actually a chart, your line chart. If your brain is so, so fast, you'll be able to, because it's small, it's not big, you'll be able to imagine the chart backward or forward, and you'll be able to tell what will happen next. But if you don't want to go through that, you can come here, chart. You click on this chart, and then you select tick, and you select 1 minute. And then you will see the candlesticks. These are the candlesticks. What is happening here right now is what you are seeing here right now. This chart, you see, this is a massive buy, continuous buy. Okay. Now, this same indicator, we can come here and say, I want to put those same set of indicator here. So I put 21, moving average 21. I put moving average 14. And moving average 7. Okay, so I just put those 3 moving average and say, okay. Confirm you can see what I'm doing.
Yes.
All right, so when you see this, so where's that SL? When you see this, okay, and you say, okay, let's say my account there is 18. I say, okay, my account is 1,800. Okay, and 2%, if I want to reach 2%, 2% of this is $36. So I will come here, sorry, I will come here and put 36 here, 36. Okay. Now, when I put this 36, what I will do, so this is the risky part. Look, this trade, depending on what you want, if you come here and select payout, your profit will be small. Your loss will also be small. If you come here and select stake, your loss is total and your profit is big. So if you look at this, my profit in this case is payout is 69.89 minus 36. That is my profit if I trade and I win. Okay. But now I have to look at this chart carefully. Number one, if I'm looking at this chart, because of this size, I don't know where the chart is coming from. So what I normally would do, I would bring this chart and make it small so that I can see where there are previous support, resistance, and all that on the chart. So I can see that this market has hit a previous resistance area. And then the market breaks back into the resistance, right? So now the market breaks above the moving average here, pull back, and then breaks above, and then gave us this buy. So now this market is pulling back. But now it's not when you are trading this, you are not looking at just the candle. You are looking at both the candle and this very small guy here. This small guy is showing you what is happening on this candle. So when you look at it very well, you will be able to tell when the market is going up and when the market is going down. Okay, but now, let me see if I can get one trade, a good trade, then I'll enter the trade and then I will interpret it for you. Okay, so you can see that the candlestick is buying. Okay, showing that the market is going up. And now this line tells you the market is buying. Of course, the line tells you the market is buying. So we're going to see if we have an opportunity to buy, or we can even sell, because if this small candle here acts as an order block, it can bring this market down. It doesn't matter whether he's breaking it right now, it doesn't matter. If this candle is an order block, it can still bring this market all the way down. Okay, except it's not a valid order block. And then this can also be another order block here. You understand? Okay, so the market has broken above here. So there's a chance that the market is going to buy. But so you will be looking at this. Normally, when I do this, I do it freestyle, right? I don't need to spend too much time. Yes, Yusuf, go ahead. Yusuf, you want to ask question? Sahid, can you hear me? Okay. So if you see this place order block can also bring the market down. Okay, so it shows me sign that is coming down, but then it has already moved. So I need to wait. I won't be able to enter here. Okay, so I give it some time. All right. Okay. All right. So when I see an indication that the market is going to continue to sell with what it has given to me, then I will enter sell. But if I feel the market is going to buy, then I will enter buy. But when I buy or sell, it's going to meet one of those two conditions that I showed to you before. Okay. So let's see what happens in this case. Okay. So 1 minute. So let's take a buy. So it's showing to me that the market is going to buy. So let's see. So if at the end of 5 movements, if this thing closed above here, can you see that it tells me that I won the trade? Can you see that in 5 seconds I have made how much? I have made $34.74. Can you see that? Can you see that my balance has changed to 1846? Now this 34.74, I'll come back to this my Excel now. Look at this my Excel. Okay. Okay, so that's 34.74. Here is 33 because the percentage is not the same. I'm not using the right percentage here. If I use the right percentage here, it will reflect that. But then my next investment, the next investment I will do is to put 34.74. So here I will come here and type 34.74. Okay. Then I will now wait and see what the market is telling us to do, whether to buy or to sell. This one, you know the beautiful thing about this one? Every trade is 5 seconds. And you can do this thing. Normally when I'm doing it, I do it with 50 something or close to $100 sometimes. Okay. So that I might just say I want to take 5 trades or 10 trades. Okay, and I'm done for the day. Okay. So once I do that, you notice that you will spend less time, you will make good profits, and you will have less stress. Okay. So I want you to also be looking at this chart based on what we have taught. Okay. If you remember, we said the market breaks the trend line, take out the A, test the trend line, and then the market will sell. You need to apply that on this thing that you are seeing here, this thing that looks like worm. You need to apply it. You are not seeing, you are not, I don't know how to describe it now, but basically you don't need to apply it. And how do you apply it? You will see it that, you see this trend that is coming down, this market that is coming down, it did that condition that I just explained, you know, and in the course of this class. Break the trend line, take out the A. But now, remember, this one that you are seeing is 1 minute. If you want to see it like this, all you need to do is just to come here and change it to tick. Then it will now be appearing like this as it's appearing here. So this and this now is exactly the same. Okay, but most time I don't like it because it confuses me. So I like seeing the candles. So that's why I normally switch to candle. Okay. So when you switch to candle, all right. This market is going to do another buy. So that's a doji candlestick in the buy direction, right? So let's see how many tick is it going to do to the upside. If it does stick to the upside, then we can buy. But if it doesn't, we'll wait. We need the market to take out the top of the doji in order for us to buy. So let's see if we're going to get that. Okay. All right. So that's the top of the doji taken out. So it tests it, and then it say continue. Then I want to put a buy. Buy. Okay. So now I say the market is going to buy. So at the end of this buy, the market should be above this line. If it's below this line, I will lose. Can you see that? 1. Can you see my profits? Can you see my balance that I changed to 1,880? Okay.
Master.
Now, if I do this thing 10 times, if I can successfully do it this 10th time, at the 10th one, I will be $13,322 in my account.
Are you looking at it?
Yes.
How can we have it? How can I have this thing here, Prof? How can I? It's not working here.
It's not working. It's not working there.
The
No.
risk is high, oh. The risk is high. Don't think of it.
Master.
No,
It is
there. It is not rocket science. Prof has already explained everything. It's the same principle.
Simple.
You can. Yeah.
Master.
Principle is the same. You
Most
say
fish account balance.
okay, so I've not successfully done the 10 at a stretch, but I think I've done it up to 7. I've done it up to 6. And sometimes, you know, because the money when you get to 6, 7 is making some sense, you don't want to risk it. Because for me to do 9, I have to risk $3,500. You know, and you know that's a lot, right? So sometimes I just make I just go with my 2,000. No need to take longer truth. But trust me, if you do it over time, like I was showing it to you now, you do it over time, this is just 2%, right? You'll be amazed the kind of result. So imagine if I have to change this to 10%, 10 times. By the time I'm done with the 10 trade, I'll be $66,000 profit in my account. Now, you can decide to say, I don't want to rush this 10 trade. I will do the first trade, and after 1 hour, I will do the second trade. So you can decide to say, I want to do this 10 trade in 10 hours. You can decide to say, I want to do this 10 trade in 10 days. It's up to you. You can discipline yourself and say, like now I've won 2 trades, right? Let's assume that I've decided I want to do this 10 trade in 10 days. I only need to do 1 trade. And that 1 trade, if I come back to the trading platform, I will need to wait very well. Just imagine this one now that Imagine this one that I did, this last one that I did that I won. Why did I win it? I explain it to you. I say the market formed a doji. Look at the doji candlestick here. And that doji is coming from a support area, right? This area is support area. Form a doji. So I expect the next candle to be going up, right? So now, but now this tick we're talking about, I just need 5 tick in the midst of multiple tick. How am I sure I'm going to get 5 in the direction? That's why I need to stay in the trend. It will take 5 times more in the buy direction right now than the sell direction, because the market is the highest force, the highest momentum is to the upside. Do you understand? If I scroll this market backward, say let's go back in time and we'll see where the market trend down. Let's see a possible trend down. Good. See where the market trend down like this. All these movements that are coming down, they are experiencing a higher momentum to the downside because these moving averages are all parallel to each other, lined up, telling you that the market is going to sell. You understand? So this is just one of the many things you can do with the Forex knowledge. It is not rocket science, and it is not gamble. It's a technical knowledge that you have and you are applying it. It's just like you are a medical doctor, you have finished your school. You will not just go to work and start working. You go and do another set of training. You do housemanship, you will do a lot of training, and you now start applying those things that you have learned. That's exactly the same thing we are doing here. The same thing for the electrician, the same thing for the mechanic, the same thing for the oil and gas professionals. You do this training, you know it, you master it, and then you come and start applying it. And then use it to make money. So let's say by tomorrow morning, I turn this money to 1,000, I withdraw that 1,000. I'm no longer risking anything. Every other thing I'm making is profit. You understand? So, guys, then we'll call it a day today. I need to take my dad to the hospital to take this
So
injection.
which platform is this one, sir?
This one is called Deriv. The name of the broker is Deriv. Let me show you their site. This is their website.
I've downloaded it over here. It's not allowing me. So it's not applicable. It's not working over here in the UK.
Okay, so for some countries, in fact, some countries don't allow MT5. Some countries do. There are different regulatory agencies all over the world. So those that regulate Nigeria are different from those that regulate UK. So some countries may not allow it. Some may allow it. But it doesn't matter. You are in UK, use VPN. Put on your VPN.
Okay.
The last time I went to China, if I got to China, as soon as I enter my hotel room, the first thing I did was to open VPN and open this same Deriv. And I traded the first set of trade in less than 20 minutes. I made $500.
Wow.
In less than 20 minutes.
Okay, so if I get a VPN, I should be able to trade, right?
100%. I said I'm just telling you, in China I did it.
Okay, that's fine. That settles it now. I'll go and buy VPN.
Just buy VPN and use.
Any recommendation? You have anyone you can recommend?
I was using is it normal and Nord or something, NORD. That was one I was using before.
Oh, Nord, I know that one. Yeah, that's a long time ago. Okay, I'll go and do research now.
All right, guys. So let's
Thank
call
you
it
very much, Prof. You're the best. Thank you so much. Really appreciate it.
Thank you.
God bless you. Master, thank you very much.
Deriv website.
Okay.
Master, see as you dey flip dollar like say you dey flip coin. Master, you dey flip dollar like say na coin.
That's coin now. So this is their website, Timothy, deriv.com.
Voila.
So you come here, you can create a free account. You don't need to pay. Once you have created the account, you can do any other thing. You can have access to all these things I'm having access to now.
Is it MT4 we create or MT5?
They use Deriv usually uses only MT5.
Okay, sir.
Like this one that I'm showing you, this one I used to teach you people today. It's also the reef. It's 75. So you can also trade it
Okay,
like
sir.
then you can trade your
Like
you can
normal.
your normal trade, and then you can trade this one that I
Okay.
just showed you now. If you use the
Okay, sir.
compounding method, you can make so much money with it. All right, thank you so much.
Merci
And
beaucoup, sir.
let's do this again by Sunday. Okay.
Thank you very much. Appreciate you a
Sunday
lot.
is
Thank
not,
you. God
is not
bless.
it. Oh. That's first Sunday of the month. Yeah,
Thank
engage.
you. Thank you.
That's first Sunday, so we're going to wait till second Sunday. All right, thank you for reminding me.
Okay, Master, for the newbies we have, how are we going to, is until we finish this lap that we can have them.
I need to finish this lap first because I can't take it halfway and leave it.
Yes, sir, I understand.
I don't want to follow me to the hospital.
Okay.
All right. Okay, all right. Thank you,
Thank you,
everyone.
sir.
Yeah, bye.
All right, sir.
Please, what? Okay, sir.
Thank you.
How about?
Sorry, come back.
Yes, I was asking about the videos you recorded. How are we going to get it, sir?
I'll drop them on my YouTube channel. Just go to the channel, you see it.
Okay, sir.
And just go to the channel. I dropped the link of the channel on the group. But let me just drop it again. But I dropped it on the group the last time. YouTube.
Thank
I
you.
need all of you to go there and go and watch those videos, eh? So channel. Yeah, so they are there. Everything is there. So if you go there, this is the link. I'll just drop it on the chat group now. Message. Control P. So that's the link. Just click on that link and it will take you there. You can download it if you want to. Stop share.
Not there.
Have you seen it?
It's not in the group chat.
I dropped it now. Scroll down, scroll the group chat to down. It's there. I'm seeing it.
Is there another group?
You're not okay. Don't worry. I'll turn it to your WhatsApp. So stop recording.